Welcome to TradeTheNBI.com. This is John. This report is for the 20th of December, and Scrooge has come early in the name of the Fed. And, you know, I've railed against the Fed and what they've been doing for, well, at least since they started raising rates under Yellen, and they've been arbitrarily doing it. This, you know, the quotes and everything that they give about normalizing, you know, their balance sheet and interest rates in general is just a bunch of baloney, because what they're really doing is shutting out the potential of any asset bubbles and really tightening credit very fast, which is exactly what they did in 2008 for a little bit more legitimate reasons, because Bernanke was terrified of inflation and wanted to keep that same concept with Greenspan, and they really don't care about what the effect is. I mean, you've already been seeing in places like Nevada and that, where, you know, Las Vegas saw no bids for homes and things like that, and that's what this interest rate increase is just going to do. It's just going to stop the economy in its tracks. And so when you're looking at future value, which is what all this rise going back here for the last year was on the potential of, you know, year over year growth, this is telling you that the party's over. You see, I have that other line. We have to actually go way back, and you don't even want to know the numbers for below that. That goes back to this dip below the red line, all the way back here. And what was that, in October or September 25th, 2017? We go down to the 2300s, and before you get to the next one. So there's a big range there. So right around this 2505 becomes kind of critical. Otherwise, there's a long way to go further south. Not surprising, we've hit each one of these beautifully. Now, there was the big pump up in the morning, anticipation, and the reality was, the quiet thought was in the market, hey, maybe the Fed does nothing. And in which case, we had a huge buy up, got us all the way back up to the 26. And things were looking so strong because people wanted, because hey, if they don't raise rates, we go all the way back up to the 2730s and probably break up towards moving towards that 3,000 in no time, because at least then you'd have a cessation. Now, how far it would go back up would be an interesting one, because there's still, it caused enough damage already with the rate increases that we've had. So fine, they did it, and the effect was pretty much immediate. It was interesting. It was Grace's birthday. I had time to bake a cake, wrap gifts, and do all sorts of things, and still trade this market pretty effectively, because we were just in a basic up push until we knew right before the signal was going to happen, and we knew when that would be. And sure enough, it did exactly as expected, and that was pretty fun ride. The liquidity was tiny. I mean, we had points where there was only trading, you know, 5, 10 contracts, in some cases 2 and 3 on some of the bids, and you were moving 3, 4 points in seconds. So you had to, that's why I put on the Skype chat, you had to be not a faint of heart to be able to handle it. But from a daily, looking at these shakeouts, look at that, it's just a straight down. There wasn't anything crazy. This is obviously bolstering Euro trade, because actually the Euro is doing so wonderful. It's ridiculous. And this is even more bizarre. That flight to Treasury is quality. People are willing to take little or no yield just to get out of the equities, simply because the fair trade is too great right now, and so they're looking for safety over yield. And in that case, in some of these people's cases, it might actually be a better thing for them, simply because they just don't know what they're doing, and they can't read a chart because they don't have the right indicators in some cases. In some cases, institutional guys, they never really were good traders in the first place. They just kind of buy because they just have a constant inflow of money. And that's a whole different issue. Oil, this, like we talked about, you know, there's a reasonable point where coming down is good, and then you start to reach a point where it becomes a little scary. And sometimes when things start to look ugly, they start to flood the market because everyone needs to make some money. So that causes a little bit of a problem. Gold retrace on this, not surprising, because you're not going to have inflation in that, with basically the economy preparing to shut down. And I know that sounds dramatic, but the reality is we saw what the effects of this back in 2008, where it wasn't that long ago, when they live in their little economic bubble of the Fed and don't really know what it's like to actually run business, or what it costs, or how much equity is lost in what you can purchase from a home. And those losses and just that quarter point increase represent a significant amount of home improvements and things that don't get done, which is a huge amount of activity that stops. And, that's irrespective of, market valuations and bubbles and that sort of thing. But, the most ineffective trade was probably, and still continues to be, share buybacks from corporations trying to bolster their earnings by reducing the number of outstanding shares. And, that's a whole different topic for another time. But you can see where we ended. This for the 5K chart was beautiful. We had that short that was ending the day, and we kind of knew that it was coming right down here into this little buy signal. And sure enough, we'd had the 38% that was slightly above, and then boom. So fine, took that. We ended up with several little, miniature short configurations, and then big longs going through, and some of them mark. And then as we started to peak out, way up here, gosh, where were we up at? 25, 80, then 92. And then beautiful DOC spread. The interesting thing is that depending on where you were in the bar, it signaled fairly early the DOC spread up by that 50% and plummeted. But even if you took it from the bottoms, this is one of those things where I always like to point that out, there was still plenty of room for that to drop. Didn't like the first pop when you that kind of decline. It's usually the second one you start to look for. I like them to make it beat the 23% to prove it. Then we ended up with a couple little rallies before the next clean DOC spread. We had this beautiful rise of red, and I always talk about this when it gets to zero level. You better keep going or look out, and sure enough, look out was the word. Once this thing started, there was just no ending it. We could follow that steel, staying way up here above it. Again, for me, that 23% on this cascade. But was I going to object to someone who, saw this buy signal down here at the lows and the sharp bounce back of the red above the minus 21? No, but not that huge difference still. I mean, that's minus 52 on that simple call right there. We still had several other decent signals and shorts in between on this little range, and these were still 10 and 12 point moves. Just didn't even bother to mark them because it was just like too obvious. As we had the little spike going into the end of the day, it was a pretty easy call to know that we were going to crash right after the close, because normally they like to fill that back in place. Simply because from a short standpoint, anyone who bought at the bottom here is like, I don't want to hold this overnight, so they get out, usually right at that close area, and that's what caused the little dip. And then we ended up with another little decline that made it to the lows, popped back up only in post-market to immediately get a new short signal. Again, this is that same one where steel crosses orange, at the same time the steel is crossing below cyan, cyan crosses above green, and nice when green can actually drop below red, or at least gives clear indication. In this case, red was also falling, and that was a beautiful one right there at the close, 25.10, and we dipped all the way down to 24.76. So they'll fight this up. Usually figure you would get a move back to the 50%, and should probably retrace a good portion of that, at least below the 23%. Would be a normal fillback going into there, and I think the market is going to have a lot of difficulties going through. You're going to get some significant rallies and fade off. So in general, you have a broader short signal that is just going to continue to bounce back and forth. But for the most part, taking either signal is going to be very effective. The nice thing about it, though, is that when the signals are coming through, we're getting really excellent follow-through as they take place. Not too much of a divergence against them at all. So from my standpoint, when volatility increases like this, we just have so much more power and so much more aggressive during this. I know it's not for faint of heart, but the reality is throughout this, from the beginning of October when we talked about it going through, I've said you have to be willing to attack this and be firm with it, because the opportunities are just significant, because so many people are going to be caught with their moving averages that are so late to the game that you just have significant returns even before they're getting a signal. So they're always lagging it, which is exactly what you want to happen. So don't pass it up. You have to be the shark, which is aggressive. But just because you're aggressive doesn't mean that you have to take situations that aren't great. And so if you don't get a good signal, you wait until you get the right ones, unless you have a little bit broader stop range, which obviously has to increase with the amount of volatility, and you have to be, matching that in like kind. But see, we're even watching here in pre-market, as I was just talking about, from the 50 dropping all the way to the 23 right now, just as we're speaking. So you gotta love it when it does exactly what you expect right before it even does it, because that's the thing, we can really see where these markets gonna head long before, and you want to take advantage of that. So this has just been the most incredible year ever. Spectacular. Just have nothing but great things to say about exactly what we've been seeing from the readings and that, which means as much as people want to complain about this, that, or the other, the algos have been on top of this from the beginning, which means it is very still organized, even though liquidity has dried up just a little bit, but it's not really significant unless you're trading hundreds and hundreds of contracts. So if that's not the case, don't worry about it. Just get in, because it's pretty clean. As always, though, trade well, and if you're still short from the 29.40 range on the daily ES from way back over here with the nice long-term put, nothing to do, just sit back and smile. So while some people will find this is going to cause great pain, others of us will say it's doing just the opposite. So if you prepared yourself properly and followed what we've been doing, it's going to be a great Christmas. Everyone else is going to be really crying in their soup. That's a whole different ballgame. As always, though, trade well. I will keep posting relevant items on the Skype chat. Have a good one.